Before we start this video, do like and subscribe to our channel and not miss on any updates.
Let's now have a look at the classification of non-corporate entities and applicability of accounting standards. This is prescribed by ICAI. Earlier what used to happen was we used to have level 1, 2, 3, 4. Lot of things to remember. And ICAI thought, let us make lives of our CA inter students slightly easier. Actually, they wanted to make life of companies easier. And they said, let us scrap all of these 4 classifications. We'll have only 2 classifications. Like we have SMC and non-SMC. Now, for non-corporate entities, we'll have MSME, that is micro, small and medium-sized enterprise or entity as you may call, and large enterprise or large entity or non-MSME entity. So now the classification is only 2 classifications, MSME, non-MSME. Let's now have a look at the criteria for classification of non-company form of entities into MSME and non-MSME. So we'll understand what gets covered under MSME. Anything that does not get covered in MSME will be covered under non-MSME or large entities. So let us look at the criteria. The first one, an entity which fulfills all the following. So to become an MSME, you have to fulfill all of these conditions. 5 conditions, every condition must be fulfilled. If any condition is not fulfilled, you will classify them as non-MSME. Okay, what is the first condition? They should not be listed or in the process of listing in India or abroad. Means they should not be listed whether India or abroad. They should not be in the process of listing. Now, what are we talking about? We are talking about a non-company form of organization. And you may have a doubt, sir, how can a non-company be listed? See, we are talking about entities which are not companies as per Companies Act. You could take example of, let us say, State Bank of India. Special Act is there to govern it. Okay. You can take an example of, let's say, Life Insurance Corporation. They are listed in the stock exchanges. You can take an example of Real Estate Investment Trust. They are listed in the stock exchanges. So, anything which is not a company and they should not be listed or should not be in the process of listing in India or abroad. Now, one thing you have to keep in mind here is, if it is a company form of organization and if it is listed, Ind AS becomes applicable. That is for your information. So, we are talking about non-company not listed. Non-company not listed. Sir, what if it is a non-company but listed? For example, LIC. Then it becomes a large entity. Okay. Then, it should not be a bank, financial institution or insurance company. If it is a bank, then it becomes a non-MSME. If it is an insurance company, non-MSME. If it is a financial institution, non-MSME. Then turnover should be less than or equal to 250 crores excluding other income in preceding year. So when we are checking in the current financial year, you have to check the previous year's revenue. Revenue excluding other income. So in the financial statement we have revenue, other income. You will not consider other income. You will only check revenue. Revenue should be less than or equal to 250. In other words, it should not be more than 250. If it is more than 250, it becomes a large entity. Okay. Then borrowing should be less than or equal to 50 crores at any time in the preceding year. Please understand, we are looking at preceding year financial information. We are checking in the current year. So, if you are in year 2, you have to look at year 1 financial information. Turnover less than or equal to 250 crores. Borrowings less than or equal to 50 crores. If it is more than 50 crores, it becomes large. Not a holding or subsidiary of a non-MSME. So, if there is any non-MSME, the holding company of that non-MSME, that is a large entity, or a subsidiary company of that non-MSME will automatically become a large MSME. So to give you an example, let us say if you have, for example, SBI. Now SBI is a bank, it is also governed by a special act, it is listed, so it becomes a large MSME. If you have any subsidiary of SBI or holding company of SBI, just for example, then this also will become large entity. So holding and subsidiary of large entity are by default large entities. Okay, quick recap. To become an MSME, you should not be listed. Turnover should be less than or equal to 250 crores. Borrowing should be less than or equal to 50 crores. You should not be a bank, financial institution or an insurance company, and you should not be a holding or a subsidiary of a non-MSME. Okay, that is the classification. If you are not an MSME, you will become a non-MSME, that is a large entity. Simple classification, no more 4 levels, single 2-line classification. Now, what is the impact of this classification? The impact of this classification is that if you are a large entity, all accounting standards are applicable. If you are a large entity, all standards are applicable. No exceptions, nothing. Everything is applicable. If you are an MSME, they have given some guidance. So guidance is some standards are not applicable fully. You don't need to apply them. Second, from some standards they have given certain relaxations or exemptions. Third, they have given one additional classification for applying certain standards. Okay. And lastly, they have said amalgamation, consolidation, those standards are generally not applicable. So 4 things we need to understand. The first one is The first one is standard not applicable in full to all MSMEs. AS3, 17, 20, 24. Accounting standard 3 deals with cash flow, 17 deals with segment reporting, 20 deals with earnings per share, 24 deals with discontinuing operation. These 4 standards are fully exempt. If you are an MSME, no need to apply these 4 standards. Okay, clear? AS3, 17, 20, 24. Then standards not applicable in full to certain MSMEs. So, if you are an MSME meeting these 2 criterias, then AS 18 and 28 are not applicable. So, what is the criteria? Number 1, turnover is less than or equal to 50 crores and borrowing is less than or equal to 10 crores. Means turnover is less than 50, less than or equal to 50, borrowing is less than or equal to 10. In that case, AS 18 and 28 are not applicable. Okay, means if it is greater than 50 and 10, these become applicable. And not a holding subsidiary of a MSME, not covered above. So basically what it means, if you are a holding or subsidiary of an MSME which has more than 50 crores of turnover, then it is applicable. So one thing that you have to understand is, if for holding it is applicable, to the subsidiary also it will become applicable. To the subsidiary if it is applicable, to holding also it is applicable. Okay. More importantly, these 2 conditions you need to remember. If turnover is less than 50 crores and borrowing is less than 10 crores, less than or equal to, then AS 18 and 28 are also not applicable. Previously we learned what? 3, 17, 20, 24. Then 18 and 28. So these 6 standards are not applicable. 4 to all MSMEs, 18 and 28 to those whose turnover is less than or equal to 50 crores and borrowing is less than or equal to 10 crores. Okay. After that we have relaxations which are partially exempted. Means some specific paragraphs ICAI has said that these are not required to be applied by these MSMEs. Okay. So any MSME, they will not apply these paragraphs. If they want, they can apply. It's okay. But they are given, this has been relaxed or these have been given as an exemption. Now these paragraph numbers and all, do you need to remember or by heart? Not required. Okay. Even if you lose out 1 or 2 marks on an MCQ, time to remember this paragraph, the time that you will spend to remember this paragraph will be much higher. Effort also required is much higher. No need to by heart. So what I have done is, I have given a summary of what is given in these paragraphs in a separate column. Just read through it a couple of times. That is more than sufficient. Of course, I will explain it in brief. Then you can read through it a couple of times. After that, whatever you can remember, it is okay. Otherwise, just ignore it. Alright. First, in AS10 dealing with property, plant and equipment, paragraph 87 is not applicable, where you have some encouraged disclosures related to historical cost and reconciliation. Certain additional disclosures are not required. Okay. Then under AS11, paragraph 44, which again talks about certain encouraged disclosures related to foreign currency risk, that is not required to be disclosed. AS15, anyways a very big standard, a lot of paragraphs have been exempted. Basically it deals with recognition and measurement of non-vesting leaves, defined benefit plans, discounting of liabilities, long-term benefits. All of these, whatever is the detailed guideline given in AS15, those need not be applied. You can take a simplified approach. So, you can assume, for example, all the payments will be done at the end of the year. A simple assumption. Okay, simple assumption can be taken and you can do the calculation. Now, one thing that you need to understand is all of these terminologies you will understand only if you have completed the relevant standard. So this part you should revisit after you have completed all the standards. Okay, so if there is something like, if you have to recognize non-vesting leaves, how to estimate the liability and all of that, no need to go to an actuary. You can do a simplified method. Similarly, defined benefit plan, use a simplified approach to measure them. Okay, so those are the relaxations. Then, as far as age 19 leases is concerned, detailed disclosures related to lease terms, minimum lease payment, contingent rents, etc., they are not required to be given. On age 22 taxes on income, MSME need to account only for current taxes. Deferred tax is optional. And if at all you are now becoming an MSME, the previous period deferred tax have to be adjusted through the reserves. So what is the meaning of this? MSME need not account for deferred tax asset or deferred tax liability. Sir, we were a non-MSME earlier and now we have become an MSME for 2 years. Now we want to take this, relaxation. Can we take? Yes, you can take. When you are taking that, existing deferred tax asset or deferred tax liability should be written off against the reserves. Okay. Then, on intangible assets, disclosures related to useful life, amortization method, etc., those can be excluded. On impairment of assets, you can use simple estimation of value in use instead of present value technique. So, no need to calculate in detail what is the present value and all of that. You can use a simple estimation of value in use. And under S29, additional encouraged disclosures like reconciliation of provisions need not be given. These paragraph numbers I have given here, again, no need to remember them. Just read through this summary part of it. That is more than sufficient for the examination. Alright. Then moving on, as far as AS 14 is concerned, that is related to amalgamation, and AS 27, generally it is not applicable to MSME because amalgamation and all we typically do not see. Okay. However, if such transaction exists, we will apply the standard. Similarly, things related to 21, 23, 25. 25 is interim financial reporting, 21 is consolidation, associate, joint venture. MSME did not prepare consolidated financial or interim report unless required or opted voluntarily. So typically, interim financial statements are prepared by listed companies. Okay. Now, if it is a non-MSME, it may not be required to prepare interim financial statement or consolidated financial statement. So these standards are generally not applicable. However, if the entity voluntarily wants to prepare a consolidated financial statement, then they can very well prepare the consolidated financial statement. So these are the classifications related to non-company form of organizations for applicability of accounting standard. Let's now have a look at Pillar 2 taxes related concept in Accounting Standard 22. Now, first thing we need to understand, what is this Pillar 2 taxes? Now, first thing we need to understand, what is this Pillar 2 taxes? Okay, you would have learned about alternate minimum tax. Okay, you will also learn about MAT subsequently. What is this Pillar 2 taxes? Now, for this, we need to understand what happens generally globally. Okay, so let's say for example, there is one company in United States, Google. Okay, you have a company in United States. In United States, assume for a moment tax rate is 25%. I'm just assuming, okay? Don't go and say, sir, it's only 22% or it is this percent, that percent. Assume it is 25%. Now, Google wants to save taxes. So what does Google do? Is Google creates a lot of subsidiaries across the globe. Some of them because they want to do business, a lot of them because they want to save taxes. So one of those countries, maybe let us say Mauritius, where assume for a moment tax rate is only 5%. So what does Google do? Google will create a subsidiary in Mauritius and they will try to route a lot of revenue to Mauritius. Now what happens because of that? If that was billed to United States, you have to pay 25% tax. If you are booking that income in Mauritius, you have to pay only 5% of taxes. So because of this, what is happening? US is losing out on revenue. And tax havens are getting a lot of companies which are registered in those countries, right? Now this is causing losses to governments across the globe. So what they have done is, there is an organization called OECD. There is an organization called OECD. They have come together and they have said, if you're trying to save taxes by doing this, transfer of income or by creating companies in different places, what we will do is we'll put a threshold of minimum tax of 15%. Minimum tax of 15%. So what this pillar 2 tax says is, you have a company in Mauritius, no problem, you are paying 5% tax as per Mauritius government's rule. We don't have any problem with that. But if I am looking at Google as a group, because it is your subsidiary, Google has a subsidiary in Mauritius. So Google as a group, if I am looking at it, I see that Mauritius subsidiary is paying only 5% tax. So what the US government will say is, boss, your effective tax rate should be 15%. You are paying only 5% in Mauritius. Balance 10% you pay in the United States. Balance 10% you pay in the United States. This is called pillar 2 taxes. This is called pillar 2 taxes, right? So I hope you have understood. If a group has a lot of companies across the globe, and if the effective tax rate is less than 15%, the difference has to be paid by the parent company or the holding company. Now, who will pay, how much we have to pay, all of that is not our discussion. We have to see what is the accounting treatment to be given. Okay. So, a lot of companies pay very little tax by shifting profits to low tax countries. So, I'll register a subsidiary here, subsidiary there, and then try to lower my taxes. To stop this, over 135 countries are working with OECD, that is Organization for Economic Cooperation and Development, on global minimum tax. Like we have minimum alternate tax and alternate minimum tax, now they have introduced something called as global minimum tax, which is also called as pillar 2 taxes. Okay. So who has to pay? The holding company has to pay. Okay. Is payment a problem? No problem, they will pay. Our thing is, how do we account for it? Okay. Now the next question is pillar 2 applicable to all the companies? No. The global minimum tax is applicable to large MNCs with revenue of 750 million euros. So the revenue threshold is 750 million euros. It is in 2 out of 4 years. Okay. Here we don't need to get into the technicalities of it. If a company pays less than 15%, the group will have to top up the tax to reach 15%. So if a subsidiary is paying less than 15%, the parent has to pay the balance tax. To whom? To the country in which the parent is registered. Okay. Now, what does Accounting Standard 22 say? Accounting Standard 22 says that you have to, whatever tax you have to pay, whatever tax you have paid, you have to create current tax expense. You have to create current tax expense, current tax liability. Those provisions are applicable. Whatever you have paid, current tax provisions are applicable. But deferred tax asset and deferred tax liability are not applicable. Meaning to say, from the point of view of this pillar 2 taxation, what the standard is saying is current tax provisions applicable. Current tax provisions of AS 22 applicable. Deferred tax asset and deferred tax liability provisions of AS 22 not applicable. Means we don't need to create DTA or DTL with respect to pillar 2 taxes. Okay. Now, AS 22 requires certain disclosures. Number 1, state that the entity has applied the exception, that is no DTA, DTL for pillar 2 taxes. We have not created DTA or DTL for pillar 2 taxes. Then disclose the current tax expense and income related to pillar 2 taxes separately. If there are any current tax income or expense related to pillar 2 taxes, you have to disclose it separately. If pillar 2 tax laws are enacted but not yet effective, disclose the estimated impact and exposure. Means the law is enacted but it is not yet effective, disclose what is the estimated impact. And disclose both qualitative and quantitative information like countries affected, proportion of profits that may be impacted, effective tax rate comparisons, etc. So provide qualitative and quantitative disclosures. Which all countries we have operations in, where we are getting affected, how much of tax we may have to pay, okay, how much percentage of profit will be impacted. Those quantitative and qualitative disclosures have to be given. MSME companies are exempt from disclosures under 32C and 32D. So very simple amendment, I would say. Just that you need to remember, there is something called as pillar 2 taxes, where the parent has to pay tax if the subsidiary is paying less than 15% taxes. As far as AS 22 is concerned, you will account for current tax expense, current tax benefit, but you will not account for deferred tax assets and deferred tax liabilities.